Okay, traders. Now, there's one important aspect I really want you to get your head around. It's around the 3-to-1 risk to reward ratio, or reward to risk, it really should be. Now, this is something that we're always trying to aim towards. Okay, and what we're trying to do is make sure we make maximum profits for the opportunity against the amount of risk we're putting in. Now, if your risk to reward setup is based on a 1-to-1, well, you can make cash, but slowly but surely you're going to get swallowed up by the losses. Now, there's something very important here that let me just explain, right? And this may change the concept for quite a few of you. Now, when you're looking at the risk to reward whole setup, right? And I know a lot of you have been maintaining positions, trying to make sure you hit those 3-to-1 risk reward returns, make sure that I'm sort of happy and all that sort of stuff. It's not about me being happy. Now, 3-to-1 risk or reward to risk ratio, I'll say what it is, because you're trying to make 3-to-1 profits versus risking, say, one lot. Now, the whole concept of this, we know over the last few years, the market has been disjointed. It doesn't run. We see volatility come in and then slowly diminish, and the currency stall. Now, the whole aspect of the 3-to-1, right, comes back to the opportunity in the market. Right now, what I'm talking about is I've got euro up here, and say we were coming down, euro's just dribbling lower towards this support trend line. What you have to see in the opportunity before you trade is if I put a trade on here for a break trade to the downside, okay, looking for that move down, is there a 3-to-1 risk reward opportunity here? It doesn't mean that you're going to take, say, 3-to-1 profit against the amount of risk you're putting on, but is that really in there, right? So what you may have a situation where you go to get in here and there's other trend lines, right? Here, here, and here, right? And it's going to really slow down. As euro goes down, it's going to hit the first trend line, it's going to stall, it's going to hit the second one, it's going to stall, it's going to hit the third one, it's going to stall. So really the opportunity for you to make 3-to-1 risk, like return here is not really there. So when you come into an opportunity and you're thinking about, okay, is this a good trade? Think of the 3-to-1 risk reward ratio. Is there potential for me to make 3 times as much as I'm risking? Whether that's on the top side here on euro, or even, potentially selling a rally. You've got a thing here. Is there a 3-to-1 risk reward return here? In this situation here, say you're looking to get in around 114.80, well, that's the trend line. So 114.70. Is there sort of like 100 points here in the move? Well, 114.60 or 70 down to 113.40. Yes, there is. So you're like, okay, there's a 3-to-1 risk return there. That is a trade I can put on. Now, at the same token, if euro was breaking down, I'm getting in below the market. You can see there's no support trend lines to screw up the whole plan, right? So there is a 3-to-1 risk return there. Now, once the positions are put on in the market themselves, right, we know that different events can happen. There can be announcements. Okay, you got these entry levels, right? But once the trade starts to play out, say on the break and the downside here, it may move down 40 points and then stall, right? In this situation at the top, it may hit the top, come back down, say 35 points, okay? 35 points in the cash or 40 points. And then it starts trading sideways for 3, 4, 5 hours, right? What that tells me is the move has been diffused, right? By either the markets, no activity, or different fundamentals. In that aspect, what I would encourage you to do is, bag the cash, take the cash, take the 40 points. You're not going to go broke doing that. And this is why, primarily because when you go into the trade has got a 3-to-1 return to risk ratio. Right. So that gives you the advantage in the market. It doesn't mean you have to hold out for 75 points if you've got a 25-point stop loss, right? But what it allows you to do, it clarifies the trading opportunity. Now, when you go into a trade, right, say like this break trade, and say you've got a 25-point stop loss and a 75-point take profit. Now, if you go into the trade thinking, well, it's got potential for a 3-to-1 risk reward ratio, and then you just start taking 20-point profits all the time with that plan in mind, well, you're really undermining your risk reward process and the trade plan. So really what you want to be doing is You're looking to get into the trade. And then if it stalls, get out, right? If you haven't been making any sort of significant cash and you've got say a 75-point take profit, 25-point stop loss, you're getting in down here. Now, what I would suggest you do is stagger your take profits, right? To get some of this out. So it doesn't, just because you say it gets into 25 points in the cash, right? You take a quarter of the position. You get to 40, you take another quarter. You get to 55, and you take another quarter, right? So then the last quarter of the position is taken out at 75 points. Over the course of the average, it's going to be around around 50 or around there, 45 or something. So with that, yeah, you're managing the opportunity around what the market's been delivering. If it's normal market conditions, right, and we see the market starting to run straight to 75, well, then that's when you start removing these early take profits, right? So that structure there is very good, right? And it's smart depending on what's happening. So it's always good to lock in some cash, because if you've got staggered take profits, right, yeah, sure, it's going to sort of eat into a bit of your 3-to-1 risk reward ratio, but it's going to get you cash in the tin. And with the stop loss being up here at 25 points, you're still going to have the opportunity to get into the trade. What we're trying to stop you doing is just getting into trades looking for 20 points, right? The whole lot, you take it. In other situations, if you're looking for the big opportunity down, it drops 20 points and stalls, trade sideways for 8 hours. Well, now you're managing the trade, right? It's not like you've gone into the trade thinking, I'll just take 20, but if it stalls, well, then just take what's on offer, right? 20 points, or reduce your stop loss down to break even and see how that goes. The whole aim of staggering your take profits and having your stop loss up here and bringing it down to break even and all these sorts of things is to keep you in the position if it's still moving, right? To give you that opportunity. But if you see a situation where, like here, you go back over a 3 or 4 day period where it just trades sideways for 3 days, well, you don't want to be running the risk through that, because anything could happen. It's lost control, momentum's been diffused, and you're now out on a limb, right? So with the 3-to-1, I think this may change things for a lot of traders, right? So what you're looking for is, when you go to put the trade on, is there a 3-to-1 reward to risk ratio? On the downside here, yes, right? If you're looking for a situation up here where you're looking to range trade and get back into it, there is, but it's not as clear and gorgeous as the downside here, because there's no support anywhere, right? We do have resistance here. It may come back down into the range. It's an opportunity there. I don't think it's as good as the one on the downside. So when you look at the setups, just make sure the reward to risk ratio is there. If it is, it probably means it's a good trade, right? And when we say a good trade is, you've got the entry there. Oh, sorry, the trend line, you've got the entry. And with a good trade setup, what will happen is you should have at least probably 2, 3, 4 times the opportunity to get out of the trade with no cash. With no loss, okay, and potential profits, right? You get into the wrong level, you get kicked in and you flush straight back out, and that's not a good situation. Usually happens, right? If I draw another trend line here, when there's another trend line below, really, is the 3-to-1 there? No, it's not. And you're actually just trading probably price action and not looking at the overall opportunity. So just weigh that up, right? I don't necessarily need to see your profits 3 times as big as your risk, right? Don't get suckered into just taking 20-point profits as the initial plan. Assess the trading opportunity based on, is there a 3-to-1 return here or not? If there is, well, then you got the right trade, put the trade on. Now you can start staggering your take profits, lower your stop loss, have a look at the market. If it's trading sideways, take the cash, right? What that's going to allow you to do is build capital without worrying about your risk to reward returns. It's all about the entry. Does it fit that profile? If it does, then it's the right trade. Once you put the trade on, things can change, right? And next thing you know, there could be an announcement, the currencies are going against you, and you're thinking, I've got to stay in the trade. I don't want to upset my risk reward ratio. No, the answer is take the cash, right? And even if it stalls for a significant amount of time, take the cash, right? the situation's changed. Like we read the market and we can see what to do, but then afterwards we can't control what comes out and what happens. So you've got to like work with that. So don't get stuck trying to make 3 times as much as you risk on each trade, because you will come unstuck, because the markets will stall and turn around. Bag the cash if you can, but most importantly, make sure that risk reward ratio is in the opportunity when you put the trade on. Afterwards, whatever happens, happens. All right. Hopefully that clears things up. If you've got any questions, let me know. I hope that helps. Cheerio.